What would you do if the world-class Japanese giant spent 2 years and $3 million on something and still leave it paying hundreds of millions just to escape it? As a person, would you see an opportunity, or you would run as me? Because that's what happened to Ambatovy nickel mine in Madagascar. Ambatovy didn't sell this mine. Instead, he paid $418 million just to exit. And I want you to pause on that. Companies don't pay to leave such a winning asset. They pay to leave when the losses have become very heavy to carry. And here is a point that's gonna shock your mind. I mean, who sees such a situation and say, I'll take it? Like seriously, why? And the answer is a South African billionaire called Sandile Zungu. So let's say this move could be an opportunity or the most intelligent, or it could be a trap even the most experienced Japanese giant couldn't escape. Maybe, possibly both. I'm Mariam Keza. Welcome to Billionaires Africa. The Ambatovy nickel mine sits in Madagascar, and on paper it's a dream asset. One of the largest nickel laterite operations in the world. Built for scale, built for long-term production, built with ambition. But there is a catch on here. Laterite nickel ore is very difficult to process. It requires high-pressure acidic leaching, a method that is not just expensive, but extremely sensitive. A small operational mistake can turn into a massive financial losses. So Sumitomo launched a project in mid-2000. During a wave of commodity optimism, everything looked promising by that time. But the reality hit hard. Capital cost exploded. Technical complexity turned out to be far greater than expected, and then the market turned against them. Nickel prices fell. Years passed, losses stacked up. And what they were left with was not just a broken mine, just a functioning one that simply refuses to make money at the price they were operating under. After 2 decades and roughly $3 billion invested, Sumitomo made a brutal decision. They exited. So coming to the highlight of today, who steps in after a situation like this? Sandile Zungu, founder of Zungu investment company, Zico, and one of South Africa's most established black industrialists. His track record spanned energy, infrastructure, and industrial investment. But there is another layer to him that matters here. He understands scale, he understands institutions, and he understands long-term bets where timing matters more than emotions, and also chairs a Amazulu football club, which interestingly reflects something about his approach. Building identity, influence, and legacy beyond pure finance. And mind you, Zungu is not doing this alone. His partner at this acquisition is Jason Clark, a former head of nickel operation at Glencore. And that detail changes everything. Because Glencore is not a casual mining company, it's one of the most aggressive, data-driven, and operationally ruthless commodity traders in the world. Clark understands nickel at a technical level most investors could never reach, especially laterite processing, the exact challenge that made Ambatovy so difficult in the first place. So what you have here is a very good combination of capital and strategic positioning from Zungu and technical operation expertise from Clark, and a mine that already absorbed the worst financial pain possible. And that is the setup. Now let's talk about the upside, because there is a real argument here. First, the mine is not broken. It already existed. It already operates. It already has infrastructures in place. And that matters more than most people realize. Sumitomo didn't fail to build Ambatovy. They built it successfully. The problem was profitability under their structure cost and market timing. Well, second, Glencore itself has changed. With the global push towards electric vehicles and battery storage, Glencore is no longer just an industrial metal. It is a strategic input in the energy transition. Zungu and Clark are not entering at the peak cost. They are entering after someone else absorbed the most expensive phase of development. Now add operational expertise from Clark. If efficiency improves even modestly, the economics can shift dramatically. And if Glencore prices remain strong or stable, the upside expands quickly. This is the class contrarian startup. Same asset, different timing, different operators, and different outcomes. At least in theory. And hold on. I'm not keeping you there. Now let's flip the coin. Because Ambatovy is not just difficult, it's famously difficult. Laterite Glencore processing using high-pressure acidic leaching is one of the most complex industrial processing in mining. It is corrosive, energy-intensive, and extremely sensitive to operational precision. Sumitomo had decades of industrial experience and deep capital resources, and still they couldn't make it consistently profitable. And that should not be ignored. Then there is a geography. Madagascar adds a logistical friction. Infrastructure limitations make importing equipment and exporting production slower and more expensive and more fragile than established mining regions. Political and regulatory certainty also sits in the background, not always active, but always present in investment calculations. And finally, the market risk. Glencore prices are not guaranteed to stay favorable. Indonesia has been rapidly expanding its own laterite Glencore supply, increasing global competition and putting long-term pressure on prices. And if EV demand growth slows even slightly, or supply continues to outpace demand, margins can compress quickly. And here is the tension. Zungu and Clark are betting that the worst is already priced in. But Sumitomo also believed they could make this work. However, they left after losing $3 billion in this. And that fact could never disappear. So what makes this deal very interesting is not just the risk. It is what it represents. Africa-led consortium is stepping into an industrial asset of global scale, one that Japanese giant ultimately walked away from after decades of effort. And this is not a common story in global mining. It signals the confidence, it signals ambition, and it signals the shift of who takes or who gets to take the high-stakes industrial risk. But whether this becomes a case study in brilliance or overconfidence will depend on execution, timing, and a commodity market that never cares about intention. For now, it sits where exactly most great deals sit, between the genius and the disaster. And Sandile Zungu is betting it tilts towards genius. I'll see you in the next one.